Risk Management 101, How to
Hello and
Invest
welcome
to
to
X100%, the podcast where we explore the intricate world of finance through storytelling, practical insights, and a dash of inspiration. I'm your host, Eddie, and today we're setting sail on an extended journey into one of the most essential topics for any investor, risk management. Our episode is titled Risk Management 101, How to Invest Safely. Imagine you're the captain of a grand ship about to venture into vast, unpredictable oceans. The financial markets are like these seas, filled with opportunities as sparkling as the horizon, but also fraught with unforeseen storms. Without a sturdy vessel and a well-prepared crew, even the most promising voyage can become perilous. Today, I'll help you build that vessel, your personal strategy for managing risk. So grab your compass, chart your course, and let's dive deep into the art and science of investing safely. Let's first understand what we mean by risk in the context of investing. At its simplest, risk is the possibility that the actual return on an investment will differ from what you expect. But there's so much more to it. There are two main types of risk to consider. Systematic risk. This is the kind of risk that affects the entire market, economic downturns, political instability, natural disasters, or even global pandemics. You can think of it as a massive storm that sweeps across all ships at sea. While you can't completely avoid systematic risk, you can learn to navigate through it. Unsystematic risk. Unlike systematic risk, unsystematic risk is specific to a particular company or industry. It's like having a leak in a particular part of your ship. If managed correctly, you can patch it up without sinking the whole vessel. Diversification is one of your best tools to mitigate unsystematic risk. Understanding these risks is your first step towards making informed decisions. Reflect on your financial goals, whether you're saving for retirement, planning for a child's education, or dreaming of an early exit into a life of leisure. How much risk can you handle? Recognizing your risk tolerance is key. Are you comfortable navigating choppy waters? Or do you prefer the calm landscape of risk? Let's construct the pillars that will support your investment strategy. Think of these pillars as the fundamental components of a robust ship, designed to weather any storm. Number 1, diversification. Diversification is like assembling a diverse crew from different backgrounds, each with unique skills. Instead of putting all your investments in one area, you spread them across various sectors, asset classes, and even geographical regions. This way, if one part of the market experiences turbulence, your entire portfolio isn't compromised. Number 2, asset allocation. Asset allocation is the art of dividing your investments among different categories like stocks, bonds, real estate, and even alternative assets such as commodities or cryptocurrencies. It's comparable to deciding how many sails, rudders, and anchors your ship needs. A balanced mix helps manage volatility and ensures you're not overly exposed to any single market movement. Number 3, stop-loss orders. A stop-loss order is a protective measure that automatically sells an investment if its price falls to a predetermined level. Imagine having an emergency plan in place for your ship, a way to abandon a sinking deck before it drags you under. This tool prevents small losses from ballooning into catastrophic ones. Number 4, regular portfolio review and rebalancing. Just as a captain inspects his vessel before a long journey, you should regularly review your portfolio. Over time, market movements can shift your asset allocation. Rebalancing realigns your investments with your original strategy and risk tolerance, ensuring your pillars into concrete actions you can take. Assess your risk tolerance thoroughly. Begin with a self-assessment. There are many online questionnaires and risk profiling tools designed to help you understand whether you lean toward a conservative, moderate, or aggressive investment style. Consider factors like your investment horizon, income stability, and even your personal comfort with uncertainty. Build a diversified portfolio. Instead of putting all your capital into a single sector, spread your investments out. For instance, you might decide on a mix like 50% in equities, 30% in bonds, and 20% in alternative assets. This balance can act as a safety net, cushioning your portfolio against unexpected downturns in any one area. Embrace dollar-cost averaging. Instead of investing a lump sum at once, consider dollar-cost averaging. By investing a fixed amount at regular intervals, you reduce the risk of entering the market at its peak. This strategy can help smooth out the effects of volatility, much like a seasoned captain adjusting the sails gradually to catch the best wind. Define clear investment goals. Are you saving for retirement, a down payment on a house, or your child's education? Clear goals provide direction. When you know what you're aiming for, it becomes easier to align your risk management strategies with your long-term vision. Utilize modern technology and tools. Today's investors have access to a wealth of technology. From portfolio management software to sophisticated risk analytics platforms and robo-advisors, these tools offer real-time insights and automated strategies to keep your portfolio balanced and aligned with your risk tolerance. Let me share a story to illustrate these points. Consider the tale of Sarah, a diligent investor who diversified her investments across various sectors: technology, healthcare, and consumer goods. When a tech bubble burst threatened to engulf the market, Sarah's exposure was limited because she had also invested in more stable industries. Her balanced approach allowed her to ride out the downturn, ultimately emerging with a stronger, more resilient portfolio. Her story is a testament to the power of thought solely about numbers and strategies. It's deeply intertwined with our psychology. The emotions we experience, fear, greed, anxiety, and overconfidence, can significantly influence our investment decisions. Emotional biases and their impact. Think about the last time you heard about a market crash or a sudden surge in asset prices. Did you feel a rush of adrenaline or perhaps a deep sense of dread? These emotional reactions can lead to impulsive decisions, like selling off investments in a panic or chasing after hot trends without due diligence. The value of discipline and patience. Imagine you're steering your ship when a sudden storm hits. The instinct might be to panic and make drastic, hasty maneuvers. However, a seasoned captain remains calm, following the protocols meticulously. In investing, maintaining a long-term perspective and sticking to your strategy, even in volatile times, is crucial. Discipline and patience are your navigational tools in turbulent waters. Cognitive biases to watch out for. Be aware of biases such as confirmation bias, seeking out information that confirms your preconceptions, and herd mentality, following the crowd without independent analysis. Recognizing these mental pitfalls can help you stay objective and make better decisions. One famous example comes from Warren Buffett, one of the world's most successful investors. Buffett is known for his calm, measured approach even during market downturns. He once said, "Be fearful when others are greedy and greedy when others are fearful." This mindset underscores the importance of a disciplined, contrarian approach, one that remains steady regardless of market into risk management. Understanding advanced metrics can be very helpful. For example, beta measures an asset's volatility relative to the overall market. A beta greater than 1 indicates higher volatility, while a beta less than 1 suggests relative stability, allowing you to gauge the impact of market movements on your investments. Standard deviation provides a statistical measure of an asset's historical volatility, with a higher standard deviation meaning that the asset's returns have been more spread out over time, which in turn indicates a higher level of risk. In addition, value at risk (VAR) estimates the potential loss in the value of your portfolio over a defined period for a given confidence interval, making it a tool frequently used by institutional investors to quantify risk. The Sharpe ratio, on the other hand, helps you understand the return of an investment relative to its risk. A higher Sharpe ratio signifies better risk-adjusted returns, guiding you toward investments that offer more reward per unit of risk. Although these tools might seem technical, they serve as a compass by providing quantifiable insights into the nature of your investments. And whether you're a beginner or a seasoned investor, these metrics can help refine your approach and align your strategy with your scenarios that highlight the importance of risk management. Case Study 1. The 2008 Financial Crisis. During the financial crisis of 2008, many investors saw their portfolios plummet. However, those who had diversified their investments across bonds, international markets, and alternative assets fared considerably better than those who were overly concentrated in high-risk assets. The crisis taught us that even in the worst economic conditions, a well-diversified portfolio can act as a safety net. Case Study 2. The dot-com bubble. In the late 1990s, the rise and subsequent burst of the dot-com bubble caught many investors off guard. Those who had placed all their hopes in tech stocks suffered enormous losses. Investors who had balanced their portfolios with more stable sectors like utilities or consumer goods were able to absorb the shock more gracefully and eventually benefit from the market's recovery. Case Study 3. The Rise of Cryptocurrencies. In recent years, cryptocurrencies have captured the imagination of many. While the potential rewards are enticing, the extreme volatility of digital assets reminds us of the inherent risks. Investors who approach this new asset class with careful risk management, allocating only a small portion of their portfolio to crypto and using stop-loss orders, avoided severe financial distress when the market experienced dramatic swings. These case studies emphasize a key point. No matter how promising an investment might seem, it's essential to protect yourself through diversified and well-planned risk management. Let's take a moment to address some questions from our listeners. I always appreciate your engagement, and these questions often spark the most interesting discussions. Listener question 1. How do I know if my current portfolio is too risky? Great question. Start by assessing your overall asset allocation and comparing it to your personal risk tolerance. If a significant portion of your portfolio is in volatile assets like high-beta stocks or emerging market equities, you might be overexposed. Consider using portfolio analytics tools that calculate metrics like standard deviation and Sharpe ratios to objectively measure your risk. Listener question 2. What should I do if a market downturn scares me? During downturns, it's important to remember that market cycles are normal. Avoid making impulsive decisions based on fear. Instead, review your long-term goals and consider if your current allocation still aligns with your risk tolerance. It might even be an opportunity to rebalance your portfolio or buy quality assets at lower prices, provided you have a solid strategy in place. Listener question 3. Is it ever wise to completely avoid risk? Risk is inherent to investing. Avoiding it entirely can also mean missing out on potential returns. The key is to manage and mitigate risk, not eliminate it entirely. A calculated amount of risk, aligned with your financial goals and comfort level, is essential for growth. It's all about finding that balance. It's important to synthesize today's extensive discussion into a few core lessons. The first lesson is to know your risk by understanding the different types of risk, systematic and unsystematic, and gauging your personal risk tolerance. Another key insight is to build on strong pillars of safe investing. Diversification, asset allocation, and stop-loss orders form the foundation of a robust investment strategy, while regular portfolio reviews ensure that your investments remain aligned with your goals. In terms of practical execution, employing strategies such as dollar-cost averaging and leveraging technology to continuously monitor and adjust your investments is essential. This proactive approach can help manage risk and optimize returns. Maintaining a disciplined mindset is equally vital. Recognizing and managing the psychological aspects of investing by staying disciplined, avoiding emotional decisions, and being aware of cognitive biases can significantly impact your success in the market. Learning from past experiences is also crucial. Historical case studies, ranging from financial crises to modern phenomena like cryptocurrency volatility, serve as reminders that while risk is always present, it can be effectively managed with a thoughtful strategy. Finally, utilizing analytical tools is indispensable. Advanced metrics such as beta, standard deviation, value at risk VAR, and the Sharpe ratio provide quantifiable insights into the risks within your portfolio, enabling you to make more informed decisions. By internalizing these lessons, you empower yourself to navigate the complexities of the market with confidence on this deep dive into risk management. Today, we navigated the turbulent waters of investment risk, explored practical strategies for safeguarding our portfolios, and examined real-world case studies that illustrate both pitfalls and best practices. The journey through risk management is ongoing. Like any great adventure, it requires vigilance, continuous learning, and the courage to adapt. Remember, investing safely isn't about eliminating risk. It's about understanding it, preparing for it, and using that knowledge to guide your decisions. Whether you're just starting out or you're a seasoned investor, the principles we discussed today can help you build a more resilient financial future. If you enjoyed this extended exploration and found value in the insights shared, Please subscribe to X100% and share this podcast with friends and family who could benefit from a smarter approach to investing. I'd love to hear your thoughts, experiences, and any questions you might have. Feel free to leave a comment or reach out directly. Until next time, I'm Eddie, reminding you to invest wisely, manage your risks thoughtfully, and always keep your eyes on the horizon. Stay safe, stay informed, and happy investing.